Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way. So, what if I told you that making a massive 60% return on your investments this year could actually leave you significantly poorer in retirement than someone who made a completely boring, forgettable 6%?
Yeah, I mean, it sounds completely backwards, right? But it is the mathematical reality of how wealth is actually built over a lifetime.
And that reality is exactly what we need to focus on right now because, with the current market volatility happening under the Trump administration, we are seeing just unprecedented swings.
Oh, absolutely. It's wild out there.
Right. I mean, interest rates are shifting in ways that keep everyone on edge. AI stocks are flying high one day and crashing the next. And the whole semiconductor space feels like a roller coaster.
It really does.
So it's like it is so easy to get caught up in the short-term thrill of chasing those massive percentage gains. But today, for this deep dive, we are shifting our focus entirely, right? Because we have to.
Exactly. We are moving away from that intoxicating emotional content of, what percentage did I make this year, to the cold, hard reality of how much actual spendable money will I have when I retire.
Because, look, percentages do not pay for your groceries, you know? And they definitely don't cover your medical bills in retirement. Absolute cash flow does.
Yeah, you can't hand a cashier a 60% gain.
Exactly. The gap between chasing short-term thrills and building lifelong wealth is just massive. And recent analysis shows that everyday investors are constantly falling into this percentage trap, especially right now with the whole AI boom.
Yeah, the beginner investor gets so drawn to those flashy numbers. Like you go to a neighborhood barbecue and some guy is bragging about how he just made a 60% return on some hot new tech stock.
Right, and your immediate instinct is to panic.
Yeah, you feel like you're missing out. You feel like you need to empty your savings and just jump in right then and there. Well, let's break down exactly why that instinct is so dangerous, looking at the data on absolute numbers. So imagine you invest a very small amount, say $10,000.
Okay, 10 grand.
Right. And you get that incredible brag-worthy 60% gain. You have just made $6,000 in profit. You feel like an absolute genius.
I mean, I'd be pretty happy with 6 grand.
Sure. But now imagine you have a much larger, more established, highly diversified retirement portfolio of $1 million.
Okay.
And you only get a boring 6% return for the year. That boring return yields $60,000 in profit. That is 10 times more actual spendable cash than the guy bragging at the barbecue.
Wow. So the person who made 6% has dramatically more spending power than the person who made 60% simply because of the base they were working from.
Precisely. And this dual reality is playing out right in front of us in the 2026 AI boom. Looking at the data from Reuters, NVIDIA is up over 1,300% since late 2022.
1,300%. That is just staggering.
It is. And that is the exact kind of headline that triggers severe fear of missing out for regular people.
But there has to be a catch, right? Like, you can't have gains like that without an incredible amount of risk building up underneath the surface.
The catch is the expectation that is baked into that price.
Hmm.
A recent Bank of America survey actually shows that 40% of fund managers view AI stocks as a massive bubble right now.
Wait, 40%, almost half.
Yeah, almost half of the pros. Because high returns represent immense past opportunity. But for someone buying in today, they represent incredibly high entry prices.
Right, you're paying a premium.
A huge premium.
Hmm.
And massive corporate expectations that are virtually impossible to meet flawlessly. We see this dynamic in international markets too. Look at the Korean KOSPI index, for example. Okay. It recently dropped 20% from its late June peak, which is essentially entering a bear market. Yet if you zoom out, it is still up 70% for the year.
Oh, wow. So depending on exactly what month you bought into that market, you are either experiencing a life-changing windfall or you are terrified because you just lost a fifth of your net worth in a matter of weeks.
Exactly. It's all about timing if you're chasing percentages.
It totally reminds me of setting the pace on a road trip. Chasing those high short-term percentages is like driving a car at 150 miles per hour for a single mile.
Right.
It is incredibly thrilling, your adrenaline is pumping, but it doesn't get you across the country. Long-term investing is like setting the cruise control at 60 miles per hour. It feels slower, maybe even a little boring, but it is the only way you actually reach your destination without crashing.
I love that analogy. And if you were driving at 150 miles per hour, any slight bump in the road is fatal. Which brings us to a massive counterintuitive truth for anyone listening who still has 10, 20, or 30 years of working and saving ahead of them.
Okay, lay it on us.
When the market is booming and moving at breakneck speed,
Hmm.
it is actually bad news for your next paycheck.
Wait, I have to stop you there because that goes against literally everything we are taught to feel.
I know.
Like when we look at our retirement apps and see the green arrows pointing up, we celebrate, we feel wealthier. So if I still have decades of saving ahead of me, why on earth is a booming market a bad thing?
Because high current returns are only beneficial for the assets you already own. They are terrible for the assets you still need to buy.
Oh, I see.
If you are a long-term investor, you are buying continuously. With every single paycheck, every 2 weeks, you're purchasing more shares in the market.
Ah, okay. Let me frame it this way for the listener. If you buy groceries every single week, you don't throw a party when the price of milk suddenly skyrockets.
Exactly.
You don't call your friends and brag that milk is up 1,300%.
Yeah.
You are furious because you still have to buy milk next week, and now your dollar doesn't go nearly as far.
That is the perfect way to look at it. When you are a net buyer of assets, you should actively want prices to be low. When prices are sky high, your monthly contribution buys fewer shares.
Makes total sense.
Let's look at the underlying mechanics of the AI sector right now to understand why this really matters. Market analysis indicates that big tech companies are projected to spend $3 trillion on data centers between 2025 and 2028.
3 trillion with a T.
With a T. Just in 2026 alone, hyperscaler capital expenditures are expected to exceed $800 billion.
Wait, for those who might not track tech infrastructure daily, when we say hyperscalers, we are talking about the massive cloud computing providers, right? Like Amazon AWS, Google Cloud, Microsoft Azure.
Yes, exactly. The absolute giants of the internet infrastructure. They're spending $800 billion in a single year to build the physical data centers required to train and run these advanced AI models.
That's just unbelievable money.
It signals very strong long-term demand. But here is the critical mechanism to understand. According to the research, a massive portion of this $3 trillion build-out is debt-financed.
Oh. And under the current economic conditions, with interest rates being as volatile as they are under this administration, carrying that much debt is incredibly expensive.
It is. It creates severe financial stability risks. When a hyperscaler borrows billions of dollars, they have to pay interest on that debt immediately.
Right.
But many of these massive data center projects haven't even broken ground yet. They are just blueprints on a desk. They will not generate a single dollar of revenue for years.
Wow.
So if you're an investor buying into that sector today at a 1,300% premium, you are paying a massive markup for a future that hasn't been built, using expensive debt that has to be serviced today.
That sounds like a house of cards.
If AI adoption slows down even slightly, or if interest rates stay elevated longer than expected, that debt becomes a crushing weight.
So when the market dips, when that bubble deflates a bit and we see a sea of red on our investing apps, I shouldn't be panicking. I should be looking at it as a massive discount on my future retirement. Milk just went on sale, and I get to buy more shares for the exact same amount of money from my paycheck.
That is the exact mindset shift required for wealth building. Short-term drops lower your purchase price, which mathematically improves your future compounding potential.
Right.
The goal is to buy steadily at various prices over decades. But, recognizing a discount logically doesn't stop the human panic response when you see your life savings drop by 20%.
Yeah, logic kind of goes out the window. Knowing I should buy milk on sale doesn't make it any less terrifying to put my hard-earned money into a market that looks like it's bleeding out.
Oh, for sure. It's scary.
So how do we actually override that biological panic response?
Yeah.
Like, how do we stick to the math of compounding when our emotions are screaming at us to sell everything and just hide the cash under a mattress?
We have to remove willpower from the equation entirely. Let's look at the sheer power of time first, because understanding the math is the first step to calming the panic.
Okay, lay out the math.
Based on recent analysis, let's take a very modest monthly savings amount, say roughly $140 a month.
Okay, pretty doable for a lot of people.
Right, it seems tiny, almost insignificant in the grand scheme of retirement.
Yeah.
After 10 years of saving that cash, the principal you've put in is only around $16,800.
Which, that is a nice emergency fund, but it's not going to pay for a comfortable retirement.
No, it definitely won't.
Yeah.
But this is where compounding alters the reality of that money. At a historically average 7% compound annual growth rate, that $16,000 grows to roughly $24,000.
Okay. Decent jump.
Now stretch that timeline out. Keep contributing that exact same small $140 every month for 40 years. It balloons to nearly $360,000.
Wow.
The main ingredient in that massive growth isn't a huge upfront salary. The main ingredient is simply uninterrupted time.
It really is like rolling a snowball down a long hill. When you start at the top, you are packing the snow tightly with your own bare hands. You're doing all the hard work, sweating over every dollar. That's your monthly savings.
Exactly.
But eventually, as it rolls, the snow it picks up on its own. The compound returns becomes vastly bigger than the snow you packed yourself. By the time it hits the bottom of the hill, it's a massive boulder. Most of that mass didn't come from your initial effort. It came from gravity and time.
That's a great way to visualize it. And the most expensive mistake an investor can make isn't paying a slightly higher management fee on a fund. The most catastrophic mistake is waiting 10 years to start rolling the snowball.
Because you lose that time.
Because you lose the steepest part of the hill at the very end. To prevent us from making that mistake, the financial industry has actually engineered psychological guardrails.
Guardrails? Like what?
Looking at the data from Vanguard's 2026 How America Saves report, we see how everyday people are successfully managing their emotions. 86% of employees now participate in their workplace 401k plans. But the vital statistic is that 61% are using auto-enrollment.
Oh, meaning they didn't even have to make the active, conscious choice to join. The company just started doing it for them right out of their paycheck.
Yes. It takes the decision out of their hands. Furthermore, 96% of these plans offer target date funds, and a huge majority of people use them.
Let's clarify target date funds for a second, just because that term gets thrown around a lot.
Sure.
Essentially, this is a fund where you pick the year you plan to retire, say 2055. When you are young, the fund automatically invests aggressively in stocks to capture that growth. But as you get closer to 2055, the fund's manager automatically shifts your money into safer, stable assets like bonds.
Right.
So a sudden market crash doesn't wipe you out right before you stop working. And you don't have to touch it. It does it all for you.
That's exactly how it works. And that automation is your armor. If you have to manually log into your brokerage account every single month, look at a scary news headline about international tariffs or changing interest rates, and actively click a button to buy stocks, you will hesitate.
Oh, absolutely.
You will tell yourself, I'll just hold this money in cash until things calm down. And by doing that, you completely break the compounding chain.
Because things never truly calm down.
Yeah.
There's always a crisis. Like recent data shows specific behavioral errors we fall into without that automation. People get emotionally attached to single stocks.
They really do.
I know there were massive software and data companies recently that absolutely plummeted because investors panicked that new AI tools were going to make their entire business models obsolete overnight.
Right. When you are emotionally invested in a single company, a sudden technological shift like AI can wipe out your net worth, or it can cause you to panic sell at the absolute bottom of the dip. Broad, automated, diversified investing, like a target date fund, protects you from that single point of failure risk.
Okay, so everyday people are relying on 401ks, target date funds, and automation to bypass their own panic. That's for us regular folks.
Right.
But I want to pivot to the absolute titans of finance. What are the world's biggest sovereign wealth funds doing with their billions? Because surely they aren't just sitting in automated retirement accounts. Are they out there chasing the AI hype?
It is incredibly revealing to look at the institutional playbook. Recent analysis highlights the strategy of Singapore's sovereign wealth fund, Temasek.
Okay, Temasek.
They manage hundreds of billions of dollars, and on July 8th, they updated their global strategy. They announced they are increasing their AI exposure from 6% to a maximum of 15% by 2031.
Wait, but hold on. Temasek manages an ocean of capital, and they have access to the best analysts on Earth. If they genuinely believe AI is the next major industrial revolution, capping it at a maximum of 15% seems incredibly conservative.
It does seem low, right?
Yeah, almost timid. Are they just hedging, or do they see a structural risk in going all in that the average retail investor is completely blind to?
They absolutely see the structural risk. Institutional investors focus on survival and capital allocation over a multi-decade horizon. Crucially, at the exact same time Temasek is increasing their AI exposure, they are aggressively increasing their exposure to highly stable assets.
What kind of assets?
Specifically, they're pouring money into private credit and core plus infrastructure.
Okay, let's unpack those two terms for the listener because that is where the real institutional magic happens. When we talk about private credit, we aren't talking about credit cards, right?
No, not at all.
We are talking about massive investment funds acting like banks, lending hundreds of millions of dollars directly to private companies, usually with floating interest rates. So if rates go up, the fund makes more money.
Exactly.
And core plus infrastructure.
Core plus infrastructure refers to physical, essential assets that generate steady, predictable cash flow regardless of what the stock market is doing. Think toll roads, massive telecom towers, or even the physical real estate that houses those AI data centers we talked about earlier.
Ah, so the physical buildings themselves.
Right. Chemisec knows that to balance the wild 150-mile-per-hour volatility of AI stocks, they need the boring, reliable 60-mile-per-hour returns of toll roads and direct lending.
And does it work?
Their historical track record proves it works beautifully. Over 10 years, they have averaged a 7.1% return. Over 20 years, 6.8%. It is remarkably steady.
It makes me think of building an American football team. If you want to build a dynasty, a team that wins championships for a decade, you don't go out and draft 11-star quarterbacks.
No, that would be a disaster.
Right. Yes. The quarterback is the flashy position. They throw the long passes. They score the touchdowns. They get all the media headlines. That is your AI stock. But if you put 11 quarterbacks on the field, your team is going to get absolutely crushed by the opposing defense.
They get flat.
You desperately need those heavy, boring, highly disciplined offensive linemen. You need a rock-solid defense. That is your infrastructure, your private credit, your boring index funds. They don't get the glory, but they protect the team. They absorb the hits so the quarterback actually has the time and space to make the explosive play.
That dynamic is exactly how institutional portfolios function. The linemen absorb the volatility. These funds know that just because an industry is definitively the future, that does not mean you should buy it at any price.
Right.
Market analysis from that same period in July reminds us that the Nasdaq dropped significantly due to massive semiconductor sell-offs. Even the greatest, most inevitable future technology will suffer brutal short-term price adjustments. Geopolitical tensions, subtle shifts in interest rates, or just simple profit-taking by large funds can tank the price of a great company for months.
So the billionaires are essentially doing exactly what the Vanguard data suggests we do, just with a lot more zeros.
Yeah.
They are diversifying, they are demanding stable cash flow, and they are refusing to go all in on the hype. So how do we take this institutional playbook and weave it into a concrete, real-world action plan for the listener driving to work right now?
It comes down to fundamentally designing your financial behavior, rather than trying to predict market movements. First, stop setting your goals in percentages.
Stop saying, I want to make 20% this year.
Right. Do not do that. Sit down and calculate an absolute cash amount. Ask yourself, how much actual cash flow do I need every month to live comfortably at age 65? Once you have that hard dollar figure, work backward with a compound interest calculator to find out exactly how much you need to contribute every month to hit that number.
And once you have that monthly number, you automate it immediately. You make it so your own willpower is completely unnecessary.
Yep. Take yourself out of the equation.
You set up the auto transfer on payday so the money moves directly into your investments before you even have a chance to look at it in your checking account. If you don't see it, you don't feel the pain of saving it.
Exactly. And the next step in behavioral design is reducing your evaluation frequency. Stop checking your portfolio every day.
Oh, guilty as charged.
We all are. But a daily check turns normal, short-term market volatility into a perceived life-or-death emergency. Judge the success of your portfolio in 5, 10, or 20-year chunks.
Checking your retirement account every single afternoon is exactly like pulling a cake out of the oven every 5 minutes to see if it's baked yet.
It ruins it.
Yes, every single time you open that oven door, you let the heat out, you ruin the temperature, and you ultimately ruin the cake. Your investments need a stable environment to grow. Just set the timer, walk away, and let it bake.
And when you are letting it bake, you have to completely reframe how you view market drops. Do not pause your automated contributions during a bear market. As we discussed, that is when your money buys the most future growth. You are getting the assets on sale.
Which leads to the absolute most critical piece of this entire puzzle. You can never, ever withdraw that money early. Unless it is a catastrophic, unavoidable, life-threatening medical emergency, you do not touch the principal. Breaking the compounding chain because you want a nicer car, a down payment on a bigger house, or to satisfy some short-term lifestyle desire completely destroys the long-term math.
It resets the whole thing.
Exactly. The snowball has to start all over again from the top of the hill. You are literally stealing millions of dollars from your older self just to buy a temporary luxury today.
If we synthesize all the data, from the retail Vanguard accounts all the way up to the sovereign wealth funds, the truth is very clear. Your ultimate wealth is not dictated by predicting the market.
Right.
It is not about guessing which semiconductor stock will win the AI race.
Yeah.
It is dictated entirely by designing your own behavior. You control the savings rate. You control the consistency. You do not control the market, so you have to stop agonizing over it.
That is incredibly empowering when you really internalize it. It takes all the pressure off. You don't have to be a Wall Street genius. You just have to be incredibly patient, consistent, and disciplined enough to let time do the heavy lifting.
That's the secret.
And that leads me to a final thought I want to leave you with today. If the most crucial factor in building massive, life-changing financial wealth is consistency, patience, and ignoring the shiny, short-term thrills, how does that apply to the rest of your life?
Well, that's a great point.
Right. Are you constantly jumping from trend to trend in your career, changing paths every time a project gets difficult? Are you doing that in your relationships or in your skill building? Because every time you jump ship for the next exciting 150-mile-per-hour thing, you are effectively hitting reset on your personal compounding. Something to think about. Don't forget to subscribe and hit that like button.